All right, it's time now for top picks. Let's start with Jason Mann. Your first top pick here, Whitecap Resources, ticker symbol WCP on the TSX. Why do you like this company so much, Jason?
So for a lot of the same reasons that we talked about in the prior segment on energy, you could have picked just about any energy stock over the last couple of years and made money. That said, you had a 5-year bear market in energy prior to that. And that 5-year bear market is really why these stocks have done so well. It really set up stocks like Whitecap to right-size their balance sheets, understand the value of consistency and not overgrowing, not using a lot of debt to overgrow. And the structural world that we're in, where you've got a desire for renewable energy sources, before we can actually reliably get off of existing energy sources, creates this really a scarcity in oil. It's the key driver of inflation right now, or one of them. And we don't think any of these things disappear quickly. So if we look at Whitecap, Western energy producer, predominantly light oils, some gas, like many companies, screens cheap. 1.6 times EV to EBITDA, less than 6 times cash flow, good yield at, call it 4.4%, with a fairly low payout ratio. And despite the energy weakness we saw in June and July, the stocks are rebounding again. Price momentum still remains, very strong relative to other sectors. So Whitecap we're highlighting specifically because they've lagged recently. One of the reasons is they bought XTO Energy Canada for about $1.7 billion. That's a big deal for them. I wouldn't call it transformational, but certainly a big deal. They're adding 32,000 BOE production, but importantly, 20 plus years of drilling inventory. And I think they've been in the penalty box a little bit by investors who would rather they continued buying back shares, paying big dividends, paying down debt, as opposed to paying for from future growth. So they're bringing on some debt to do this, but more than manageable. And they actually just raised their guidance today. So they've got a lot of confidence that this is the right thing to do, and we agree with them. We think they can play catch up with some of their peers as the shareholders that didn't like the deal exit, and as they start to delever and actually put up good numbers.
All right, thank you for that, Jason. Let's move on to our next top pick, Zendesk, ticker symbol ZEN on the NYSE. This is a company in the middle of an acquisition. Why do you like this company so much right now?
So this one is being acquired. It's a merger arb pick, and what merger arbitrage is, it's a strategy we use in our funds. Essentially, we're buying companies that are in the process of being acquired, and we're buying them for less than what we're ultimately going to get when that deal closes. So typically, this is more like a bond replacement type strategy. You're earning a little spread. What makes Zendesk interesting to us is that the history on this, they're being acquired today by private equity at $77.50. Back about, call it 9 months ago, they were in talks. They actually had another bid on the table, and in talks to be acquired as high as $140, so double the price where they are today. So in many ways, this feels like a take under from that prior price. And granted, the market it's a very different market today. So it makes sense that they would be getting a lower price. But buying it here at a price below the 77.5, you're going to earn a small return, and you get a bit of a call option on the tech market rebounding or activist shareholders pushing for a slightly higher price. So in this kind of market where you got lots of downside potentially on regular tech stocks, this is one you can own and maybe get a small bump out of this.
All right, thanks for that, Jason. All right, let's move on to our last top pick of the day. It's auto parts maker Linamar, ticker symbol LNR on the TSX.
Yeah, so Linamar, it's been a holding for us a number of times over the years. It's a cyclical business, so there are times we want to avoid it. We have been avoiding it up until fairly recently because it was in a downtrend, and you really had a lot of headwinds. COVID plus the war in Ukraine has really created a whole bunch of problems for the automakers, from lack of chips to certain components being made in Ukraine that they couldn't get access to anymore, to just overall economic softening in Europe. That said, it's now cheap enough. Linamar isn't just auto parts. They're an industrial component manufacturer. They've got businesses in industrial and agriculture as well. And you're trading now at 4.6 times EV to EBITDA, less than 12 times price to earnings. No net debt, balance sheet looks great. Insiders have been buying. They've purchased 1.5 million shares at levels similar to this. So you're buying alongside them. They've historically been quite good buyers of their stock. And price momentum starting to turn higher. So ironically, a bit of an economic slowdown may actually help companies like Linamar because it frees up the supply chains that have been the problem. And there's a huge backlog of orders for car manufacturing. So a little bit of slowdown that greases the wheels, so to speak, and gets these cars back into production could be growth for could mean growth for Linamar.